effectively, in the event of your death, your pension assets are now going to be included inside your estate for inheritance tax purposes. So previously, they were outside of the estate. Moving forward, they'll be inside the estate. So similar to your property, your cash in the bank, your investments, which are all liable, potentially liable, shall I say, to inheritance tax. The pension's now going to be pulled into that.
That makes sense. But what does it actually mean in reality? So what do people who are inheriting that money or sort of receiving potentially that benefit in the end, or even if you're worried about how that's going to be passed on, how's it actually going to work in practice?
So in practice, it's going to be even more difficult, even more administrationally heavy for those people. So, in the event of your death, shall we say, all your assets will fall inside your estate. Now, you've got a nil rate band of 325,000. Your spouse or civil partner, they will also have a nil rate band of 325,000. You may qualify for a residential nil rate band as well, the 175,000 each, if you are leaving a property, a UK property, to direct descendants. But that can also be tapered if you've got a very high value estate. So potentially up to £1 million in nil rate band. Once all your assets are put together, if that is above a £1 million, then your potential beneficiaries could be paying inheritance tax. So the personal representatives of the estate, whether that be your children typically, or you could even get professionals involved, because let's remember it is a very highly emotive time and it is quite a significant undertaking. If anyone that's done this for a family member or a loved one will know how much work goes in to managing an estate. So it will be their responsibility to get the value of all the assets, and now they'll have that added responsibility of getting the value of the pension schemes, tallying up the value of the estate to work out if any inheritance tax is paid. Once they've got to that stage, then they will have to now work out the amount of inheritance tax that is attributable to each pension scheme. Once they've got there, then they will have a couple of options. They could get the pension schemes to pay that inheritance tax liability, or they can pay it themselves. But we need to remember as well, if the individual that has passed away is above age 75, there's potential income tax liability on the beneficiaries there. If they get the pension to pay it directly, then there's no income tax liability. If they decide to pull that money out and then pay the inheritance tax liability, yes, you will suffer that income tax. You'll be able to reclaim it, but it's a bit of a messy process. So yeah, it's going to be difficult.
Definitely, and also I think what I'd say as well is, as you said, it's a really emotional time and it's really difficult. But if your main assets are a house and the pension and things like that, the liquidity of it is quite important, isn't it? Because people have to pay the inheritance tax within 6 months typically, unless you get a loan, where HMRC will charge you quite a high level of interest. So it's quite complicated making that sort of decision, as you said. Personally, if it's a difficult emotional time, it can. This is only going to add to people's burden, and that's why I think it's so important at this point to sort of come and speak to people like us, because we can support you with that process. I mean, hopefully we've been working with the family for a long time to give that guidance around areas like this and that support, but it can be so tricky, can't it?